bring in our featured guest of the morning for her thoughts on these results and the group in a larger context for investors. She's Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management. Thanks a lot for joining us.
Thanks for having me.
Any quick thoughts on these numbers this morning, Rebecca?
Yeah, I mean, it seems like this quarter, the banks have had messy earnings. There's a lot of one-time expenses or costs. But if you look at the overall, what we're looking at, PLCs are provision for credit losses. It seems to be the number one thing that analysts are looking at. And so while it has a one-time impact on overall earnings for the quarter, we look at it as a prudent move. Like, we know that these mortgages in the next year or two are going to be coming up due. There is going to be a mortgage price shock for, customers that are, going to have to renew their mortgages at 7% instead of 2%. Yeah. So I think it's prudent to take these PLCs and bring them higher, and we're expecting them to go even higher from here. But what it's doing in the short term is it's reducing earnings. So, Scotia, when they released on Tuesday, and then their PLCs were almost double what analysts had expected, the stock was down 5%. CIBC had lower PLCs than expected, and the stock was up 5%. So I think, there's a lot of short-term noise on these, misses or beats. But I think us as investors, we're looking at what this is for the long term. And we think, taking these provisions is prudent, knowing that what we know is coming down the pipe in the next, year or two. On behalf of clients, you're currently underweight the Canadian bank stocks, but you're looking for, it sounds like you're looking for opportunities to move to a market weight position or more. What would it take for you and your colleagues at Newhaven to bump up your holdings of Canadian banks for clients? Absolutely. So, we do think that this is the start of it. So increasing PLCs, I think, is a good start. We're also seeing a lot of the banks reducing headcount. So that's also creating a lot of, noise in the short term as there's higher expenses related to severances and things like that. But they are doing the right thing in terms of if there is an economy that is slowing down, to right size the workforce, I think is a smart move. So we are looking at a few messy quarters ahead, but we do think that the Canadian banks, just given the nature of the business, is a good long-term opportunity for us. So we're waiting for things to get a little bit messier, for prices to get a bit cheaper, and then we'll look at, purchasing more for our clients on a long-term basis.
Many of the banks have increased their dividends in this quarter. National has done it this morning, and the dividend, with the suppressed share prices, the dividend yields are attractive at this level, are they not?
So dividend yields are looking attractive for the banks. They always have been pretty attractive, raising their dividend 1 or 2 times a year. We do think that there is room for these banks to get a bit cheaper from here, as we do think that there are some headwinds ahead, as we talked about, potential loan losses, or also a reduction in the net interest margin. We could see that getting weaker in the next few quarters. So while the dividend yield is attractive, just based on the current headwinds, we do think that things could get a bit cheaper from here.
Are there any of the particular banks that you favor from a valuation point of view at this point?
I mean, Scotia is, the most attractive on a valuation, but they are also they had the messiest quarter. They also had, management issues. But, we definitely, prefer a TD and an RBC on a long-term basis. But again, their valuations are a little bit higher, so we're waiting for that to get a bit cheaper.
Any thoughts on what we might hear from Scotia at its investor day? There's, I think, a fair bit of anticipation building up. The company's obviously under a new CEO. The stock has underperformed for many years. Management obviously under pressure to turn that around.
Yeah, I think there's a lot of pressure on management right now to see what their plans are. I think also they have a little bit more international risks than some of the other Canadian banks. So I think there's going to look for a little bit more clarity on what they're doing with that business. But overall, I think, they're trying to do the right thing. They've reduced, headcount by 3% that they announced last quarter. So I think they're on track to do the right thing. I think it's just now a question of whether they perform what they say they're going to do.
That's Rebecca.